It's live.
A very good morning to one and all. Present in today's national webinar, should salaried employees opt for the new income tax slabs? I, Dr. SEEMA Shah, a chartered accountant, head of the Department of Accountancy of Sri Maniben MP Shah College of Arts and Commerce, Autonomous. I am fortunate to organize the webinar under Seva Mandal Education Society banner. Our very own Honorary Secretary, Dr. Bharat Bhai Pathak Sir, a chartered accountant himself, a person apt to begin the webinar for the day. I request Sir to express his opinion and ideas on this opening of the webinar. Bharat Pathak Sir.
Good morning, friends. On behalf of Seva Mandal Education Society, who runs the MMP Shah Women's College of Arts and Commerce and their Department of Accountancy, have organized this webinar in collaboration with Indian Accounting Association Thane branch. I have great pleasure in welcoming the Honorary Secretary of Indian Accounting Association Thane branch, Nishikant, the resource person, CA Santosh Ghag, who is a HOD of Jai Hind College, and also a very proactive member on various professional and social bodies. The keynote speaker, Chartered Accountant Sagar Jayawant, who is also an eminent speaker and associated with various professional and social bodies. Our principal, Dr. Leena Raje, and the HOD of Department of Accountancy, CA Dr. SEEMA Shah, and her team, who have organized this webinar. My compliments and the congratulations to all of them. And I'm sure this is a very, very important subject that in the last budget, the finance minister have introduced and proposed that you have an option to have opt for the SLAB, the old regime as well as the new. In old regime, you will know that it is where all the sorts of deductions were allowed, while in the new regime, you will not have any deduction. On the gross income, you have to pay the tax. And particularly, I'm so happy that today's participants is more than 1,000 people, where professionals, students, and other are participating. And I'm sure that all of them will be benefited with this discussion today on this webinar. Particularly the subject selected mainly for salaried employees, that whether it is beneficial to them to go for the new income tax slab or to retain the old one. Friends, once again, I welcome and compliment and congratulate all of you. Thank you, friends.
Thank you, sir,
Thank you.
for your so kind words and blessings. Builds character, inspires dreams, encourages creativity, builds confidence, instills a love of learning, touches our heart, and changes our lives forever. She is our dear principal, Dr. Leena Raje, who is ever inspiring and motivating all of us, and under whose guidance it was possible for the Department of Accountancy to organize this webinar. I welcome you, ma'am.
Thank you. Thank you, SEEMA.
Thank you for all your kind words, Seema. Yes, motivation is the key factor which keeps us going every day, and especially in the present situation of COVID-19. Only motivation is working to keep us fit and on our toes. And I think all of us who are present here today definitely will agree with this, that this is most important, I would say, process in our life. Motivation is a process and which continuously goes on. I am extremely happy today morning to welcome all of you, I would say CA family, because all of you are from chartered accountants field. And as I was just mentioning earlier that it's a family like bonding between all of you. Our resource person for today's program, Shri Sagar Jayawant sir, and our Secretary of Indian Accounting Association, Thane branch, Mr. Dr. Nishikant Jha, sir. I have not met you, but yes, I can understand the wavelengths between you and Santosh Ghag, sir. And what to talk about Santosh Ghag, sir? I know him for many years now. And my in the previous college where I was working, Mr. Gunwant Raj, I think all of you also must be familiar with him. He is he was a common factor between me and Santosh Ghag sir, but now we have left behind Gunwant Raj sir, and now our relationship has grown further. And I'm very happy to be associated with Dr. Santosh Ghag sir. I would say that while coming in this field of chartered accountancy, I think some kind of training is given to all of you people for relationship maintenance, because all of you who are in this field, I feel are very good in maintaining relationships, which is also most important in life. I am very happy that our accountancy department and the HOD SEEMA, Dr. SEEMA, since we are very close to each other, I call her SEEMA only. So Dr. SEEMA, CA SEEMA, both is true for her because she is also PhD as well as CA. Very capable and is associated with other person in the department, CA Soumya N. Both of them are very capable, lot of potentials, and I'm very happy that they have taken it ahead and they have arranged this program today in collaboration with the Indian Accounting Association. I think the topic that they have selected today is very relevant because we have this confusion, we have this dilemma, and all of us attending the program will get guidance that which path they should take so far as the taxation system is concerned. Before stepping down and giving the mic to SEEMA back, I would like to say that our college is excellent. We have become autonomous from the year 2019, but we became autonomous because we were very capable. We already have from UGC the honor of being a college with potential for excellence, and this award itself says that because we have potentials to become excellent, UGC has given us this honor with a grant of 1.5 crores, and this is the last year. I'm happy to say that the grant is very well utilized. CAs need to certify that, so I'm mentioning specifically this, that we have utilized the grant very well. I request all of you to visit our college and see the way college has developed under this scheme for last 5 years. And because of this grant, we have been able to do many activities. And now we are in the autonomy and we are utilizing the autonomy grant also to the best possible way, to the best of our capabilities. And after the lockdown is over, SEEMA, you can arrange one program in which you can invite all these respected members of CA fraternity to our college. Let them physically meet the students, let them see the college, and let us enjoy together a few moments of some brainful activity, I would say. So giving back mic to you, SEEMA, I wish all the best for today's program, and I thank each and every member that is present here. I don't think I need to thank Bharat Bhai because he's our own. He's a pillar of strength for all of us, and by his very own nature, to be very accommodative and very unassuming person, he is there always with us for any program. Bharat Bhai, not as a formality, but I genuinely feel that I should express my wholehearted thanks to you for being there with us. And all the respected members of CA fraternity, very much thankful to you. I deeply express my sense of gratitude towards all of you for making this collaboration and going ahead with this program. But I express my feelings that let this be the beginning and not the end. Let us have many more activities under this collaboration. Thank you very
Yes.
much.
Thank you, Principal Ma'am, for the good wishes and blessings. Now, moving ahead, I now call upon CA Soumya Nichani from Department of Accountancy to introduce Dr. Nishikant Jha.
I think we should exit, right, Seema?
Yes.
Good morning, everybody. Thank you, Leena ma'am, for your encouraging words. We are
Soumya ma'am, 1 minute. Soumya ma'am, 1 minute.
Yes.
Leena
Yes.
madam can stay because there are only 6 persons, so madam can stay. There is no problem. 6 person
Okay.
can be occupied, so madam can stay if she wants. Okay, carry on.
Okay. Thank you, Leena ma'am, for your kind and encouraging words. We are privileged to be associated with the Indian Accounting Association. I would now like to briefly introduce Dr. Nishikant Jha sir, who is the Secretary of the Indian Accounting Association, Thane branch. Dr. Jha is the Chairman of the Board of Studies in BAF and BFM of the University of Mumbai. Sir is the BAF coordinator at Thakur College, Mumbai. He is a university recognized guide for PhD and MPhil. Sir has also authored a number of textbooks on the subject. With this very short introduction, I request Dr. Jha to address the audience. Over to you, Jha sir.
Thank you very much and very good morning to all my dear participants. I would like to first thank to our chairman, uh, chairman of IA Thane branch, Dr. Arvind Luhar sir, who is also chairman Board of Studies, Accountancy, University of Mumbai, and my treasurer, Dr. Kuldeep Sharma sir, is also Board of Studies member for Banking, Insurance and Investment Management. I, Dr. Nishikant Jha, who is the secretary of IA Thane branch, and I am the member for Accounting and Finance and Financial Management, Board of
Madam,
Studies, University of Mumbai, with four pillars of mine, all the student, Vignesh, Ajit, Harshal, and Kanishk, who is assisting us for technical help, for getting the registration done, for giving the certificate, etc., etc. And all my lovely participants who are always encouraging. I would like to brief you about IA Thane branch. We have started our association 4 years back. We have more than 100 of members as of now. And in this pandemic, we have taken under the able leadership of Dr. Arvind Luhar sir several series of students free guidance lecture as well as national international webinars, whereby we have served approx 3 lakhs participants across the globe, including all corners of India. They have got the benefit today also. I mean, last session also, when the Sagar sir has taken, more than 3,000 participants have got benefit of his session. Today also I have got the registration approx 1,000, and believe me, after the session also, many of them, they are going and seeing this video which is there on our YouTube channel. So many a times our Arvind Luhar sir and peoples are saying that yes, we are also a kind of warrior. We are not serving the nation at our borders, but we are serving to the society at large, whereby we are, teaching and making this learning phase continued for all the participants in India and abroad. We are also thankful to all our associates, more than 50 associations we had across Maharashtra and outside Maharashtra of different university and colleges, with whom we had different national and international webinars with the renowned speakers, eminent speakers, and the benefit goes to thousands and millions of the participants who have participated in IA Thane branch event. Today we have a Telegram channels, two Telegram channel. One is for participant, other is for student, whereby we have approx 13,000 live members. So at one click, when we are sending this message, it is going to them directly. They are directly connected to us. They ask which kind of sessions they want. And I'm really thankful to all the resource person who have been with us, who have associated with us, and because of their effort, because of their excellent sessions, we have grown like anything. Within 3 months, we grown like a big family across the globe, which has so many participants, which has so many followers. I'm also thankful to SNDT College, and to be very precise and particular, Bharat sir for his gracious presence, Sagar sir, who is a eminent speaker for the day, Santosh Ghag sir, who is our family member, he is a life member for IA Thane branch, and also a very good, person who is making so many events possible for IA Thane branch with other institution of Mumbai, and all three lady member, Principal Leena ma'am, SEEMA ma'am, and Soumya ma'am. Thank you very much from the bottom of heart from IA Thane branch, and all the very best for this wonderful session. It is a tribute for all the teachers before the Teachers' Day, that how they can save their tax by opting whether old regime is good for them or the new system, they should opt for filing their returns. Thank you very much once again.
Thank you, Dr. Nishikant Jha, sir. I would now like to introduce our today's keynote speaker of the webinar, CA Santosh Ghag, Senior Chartered Accountant, practicing for more than 28 years. He is the director in Apna Sahkari Bank Limited, a multi-state scheduled bank. He is the organizing committee member of Forum of Chartered Accountants in Cooperative Banks, Vice Patron Maratha Mandir, a board member in Baba Saheb Gowde Institute of Management Studies, a trustee in Bal Vikas High School, past treasurer in Matru Mandir, head of the Department of Accountancy and coordinator of MCOM in Jai Hind College, member of Board of Studies, Khandwala College, Malad, Srimati Maniben MP Shah College, Matunga, Pillai College, Panvel, Thakur College, Kandivali, past member of Board of Studies Accountancy, SNDT Women's University. He is a co-author of various textbooks from FY BCom to MCom. He holds various responsible positions in University in Mumbai. He was conferred with Samaj Gaurav Puraskar for outstanding social contribution. I welcome Santosh sir.
Thank you. Thank you. In fact, thanks for the kind words and gracious words. Before I start, actually, I must congratulate MMP Shah College for getting that autonomous status, and we know it is given to the best of the colleges. And as I know, I think the MMP Shah College is the only second college in the entire SNDT University. So congratulations to you, and best wishes for functioning in future. Respected resource person, my fraternity friend, CA Sagar Jayawant sir, MMP Shah Women's College Governing Trust Honorary Secretary, Dr. Bharatbhai Pathak sir, Principal Dr. Leena Raje ma'am, Head of the Department of Accountancy and the backbone of this webinar, Dr. SEEMA Shah, CA Soumya N, Chairman Indian Accounting Association, Dr. Arvind Lohar, Secretary Dr. Nishikant, Treasurer Dr. Kuldeep Sharma, Vice Principal, and all the faculty members of the college and the esteemed participants. A warm welcome. First, sincere thanks to the organizer for giving me this honor. Now, today's topic is should the salaried employees opt for new income tax slabs? In fact, all the speakers before me have given the importance of, they mentioned the importance of this particular topic. This topic relates to the financial year 2020-21, That is the current financial year. This is the part of the provisions of the Finance Act 2020, which has already become applicable with effect from 1st April 2020. The provisions related to this topic were tabled in the Parliament on 1st February 2020 in the form of a bill. And since then, we had some seminars, conferences for comprehending the provisions and the tax planning. But within a very short time, the deadly pandemic unfortunately reached our country, and the discussion of this topic stopped abruptly and completely. We had to resort to total lockdown pan-India, with the Prime Minister saying, "Jaan hai to jaan hai." Even Sir Ratan Tata said that this is the year of staying alive, and even after almost 5 months, the pandemic is not subsiding. Rather, it is worsening day by day. But now we have decided to move on. We have decided to live with Corona with our new slogan, Punashya Haryom, or Mission Begin Again, or Unlock 1, 2, 3. The new order is Life and Livelihood, or Jaan Bhi Jahan Bhi. Now the employers have started deducting the TDS from salaries. The employees are required to give declaration and the estimated declaration of estimated income and the proposed investments. This means that we are in the process of making decisions about our investments. This also means that we have to decide as to whether we have to choose the new slabs or stick to the old ones. And we have already chosen, then see whether the switchover is required. Now, I know the decision is not very easy because it depends upon many combinations. Of course, these provisions will be discussed in detail by the resource person, Sagar Jayawant. So I will not go into in detail. But I must congratulate the college, and the trustee, Dr. C.A. Pathak sir, Principal Raje ma'am, and SEEMA ma'am, and everybody for selecting this topic. As just now Nishikant sir said that the participation for this has crossed 1,000. Actually, we already had 2 webinars before this on the same topic. The topic is so important that many people were left out and they were requesting us to have this topic. That's why you're happy we are having. And even after the 3rd time, we are having 1,000 plus participation. That shows that the importance of this topic. I also congratulate for getting a masterly resource person. C.S. Sagar Jayawant sir is known for his thorough knowledge and the wisdom. Not only fresh chartered accountant, but even the senior chartered accountant bank on him for his expertise, at least for the second opinion. His WhatsApp group is a huge source of knowledge. I will be privileged to listen to him today. Now the million-dollar questions. Why this change? Why the new slabs? Why no incentives for investing in the new tax regime? Now, for so many years, the investments were encouraged by the government for giving deductions, rather. Then why this sudden change in the policy? Why the investing is not so important now? I think there are 3 basic reasons for it. Reason number 1, which I think is the simplicity, which is one of the canons of taxation. Now I remember the legendary speaker, the greatest constitutional expert, Nani Palkewala, saying, and I quote, "Whatever we want to give to whoever, we try to route it through income tax. You want to give benefit to backward area, rural area, exports, women, for encouraging investment, for encouraging donations. The approach is give deductions in income tax and the job is done." But actually, income tax is made for collecting revenue and not for giving benefits. The welfare is not the job of the exchequer. That's what Nani Palkewala used to say. And now I unquote. By dumping everything in income tax, we have made it too complex. It has already have so many sections, subsections, clauses, subclauses, provisos, explanations, and case laws and so on. And by cluttering it so many things, we make it further difficult. People don't mind paying tax, but they are scared of the complex provisions. People want laws to be simple. So I think by removing these deductions, government is trying to get that simplicity. If you remember the preamble and the budget speech of the finance minister, Dr. Nirmala Sitharaman, I think it goes with it. But the simplicity cannot be the only reason. The second reason I think could be the falling rates of interest. When we invest, the wealth grows and it adds to the individual as well as the national wealth. This in turn also adds to the national development. That's why the investments were encouraged by fund. For making investment, we save more and spend less. One way this is good, but it has got a negative side also. The problem is that it reduces the circulation of money in the market. Now the interest rates on the loans and deposits is getting lower, and it is expected to go lower only or be lower only for at least in the near future. 20 years ago, the rates of interest were going up just one way, but since then, the rates are rapidly coming down continuously. I remember, possibly you also will be remembering ICICI bond example. You may recall that ICICI was a very big institution. It floated ICICI Bank as its sister concern at that time, and then ICICI itself got merged into it. This is a classic case of reverse merger. So ICICI had issued bonds at that time at 18% interest in the year 2001, but then they prematurely redeemed them in the year 2002 and reissued them at a lower rate. This is only a sample case. Many cases can be quoted. But since then, the rates are falling just one way. And in near future, we are expecting that the fall will continue. And as a bank director, I'm also more concerned with this. Anyway, so the government does not want us to invest anymore. Rather, they want us to spend more. The third reason is the multiplier effect, I think. When you invest, the money in the market gets shrunk. It goes out of circulation. But when you spend, it gets into circulation back in the market. Both the times, the effect is in multiples, but one is negative, the other is positive. I think the government wants investment to be phased out gradually, encourage the spending and consumption rather than saving and investment. That's why this decision might have been done. So I think these are the basic three reasons for the change, but many more are possible. So this is about the reason which I think that the shift in the policy of the government might have happened. Now we will go to some of the important changes which has been made by the Finance Act 2002, rather the 2020, which matter to us for the current year of only basic and the related things that take. Section 115 BAC. This is about the two different slabs which we are discussing just now. Jayawant sir is covering this one in detail, so I will not go into it, but I will glance through the other important changes which matter. Section 194 say this relate to the professional services, so and rather technical services, so I'll not go into it. Next, tax audit threshold limit is increased. That also salary persons are not concerned, so I will not go into it. But now then we come to section 80 AAE, the additional deduction for of rupees 1.5 lakh for the interest paid on home loan. This concerns with salaried person. This will now be allowed for the loan sanctioned up to 31st March 2021. So it is extended by a year. It was only up to 2020 up to by now. DDT, that is dividend distribution tax, has been discontinued. Instead, now the recipients of the dividend will have to pay tax on the dividend. That means when the dividend was paid by the company, the tax was paid also by the company only. Now it will be paid by the shareholders, that means we. So that becomes income of even of the salary people. So that now it will be taxable. Next, the dividend paid by Indian companies to a shareholder who is resident in India, TDS at 10% if the dividend amount exceeds rupees 5,000. Of course, this is the corollary. Now, since the dividend income now becomes income in the hands of the recipient, that is we people, the shareholders. Now, since it has become income, now there will be TDS of 10% of, I'm saying 10%, but now for the current it will be 7.5%, but TDS have now become applicable. So this is about dividend on income. Next, section 194 talks about dividend paid by mutual fund to the resident. TDS at 10% will also be deducted now only if the dividend exceeds 5,000 rupees. This is again the same, like if you get the dividend from the company, it is taxable. That's why the TDS comes in. Now, the dividend on mutual fund also, if it is exceeding 5,000, also there will be a TDS of 7.5% instead of 10% for the current year will be deducted. Section 206, this relates to everyone. TDS in relation to section 194O. has been brought down to 5% from a big 20% in case of non-furnishing of PAN. That means if you have some transaction and if you are not quoting the PAN, then there was a TDS of 20% earlier up to last year. Now it is brought down to 5%. Of course, this 5% again will come down to 3.5% because of that provision which is there for the current year. But then, of course, that the TDS has come from 20% to 5%. But why do that? Why pay that TDS also? You see, when the TDS is paid, only when you are not punishing the PAN. So every time you punish PAN, so that you can avoid that TDS. But not only the TDS. If you are not quoting PAN, it is likely that your case may be taken up for scrutiny. So every time when you come for and transact anything, please see that you are quoting the PAN. Then comes now the important thing which I am just telling. All the rates of TDS, including the revised ones which have been revised in the current year, are now reduced by 25%. That means if the TDS is supposed to be 10%, it will come down to 7.5%. 5% will come down to 3.5%. 2% will come down to 3.5%. 5% will come down to 5% will come down to 3.5%. 2% will come down to 1.5%. So this is this is only for the current year because of the lockdown and of course the pandemic. Next year onward, it will be at the full rate. Now, I think there is some time I can go for some tips from my side. We call them as commandments. So I'm going to the 10 commandments of e-filing of income tax returns. Actually, these are nothing but the do's and don'ts, the principle that you have to follow. Or now the buzzword is the protocol. So I'm giving you the protocol for e-filing of return. First protocol or first commandment, you can say, file return if the income exceeds basically. If the income exceeds basically, that means when you are supposed to file a return, file it in time and file it. Don't avoid filing the return. Otherwise, will be subjected to many prosecution and blah, blah. Verify TDS in Form 26AS. So whatever details are in Form 26AS, which is available on NSDL site, see that when you want to claim TDS, when you take income, see that your income is matching with the details on that Form 26AS, which is available on NSDL site. Choose the right form for filing of income tax return. So there are various forms up to Form 7. So see that you will be taking correct form. Now, in fact, I'll be giving PPT, which will be shared with you. I have given what form will be selected, but we will not be able to discuss it because it is too large. But one thing I'll say that since the returns are online, when you click it, whatever sources of income, it will automatically come. So you don't have to worry about much, but see that you are selecting the correct form. Then choose interest and any other income that you have got with your return. Because some people think if you are a salaried person, only salary is the income that you have to take because you get Form 16 from the employer. That may be including only salary, but no, whatever income you have got, maybe interest, dividend, or in my case, I get salary from the college, but I got a professional income. So I have to see that all income that I am receiving during the year from whatever sources, from wherever, I have to club together and then I have to find it. So include all income in your return. Mention Aadhaar. This is very important and nothing to be explained about it. Then don't ignore the income from the former employer. Now, what do you mean by former employer? Suppose you are having you are employed with some employer this year or maybe the later part of the year, but earlier you were with some other employer. Then the income or the salary received from that employer also you have to club with the current this salary. Then it is possible that you may be employed with some other employer earlier from where you exited, and now you are getting say the the arrears of that salary, and that arrears also will be included your income from this salary also, this year's salary. And the third case of former employee is that suppose you are with some other employer, now you are getting pension from there. That pension also becomes salary. So it is taken as salary, it comes under the head of salary. So it will be also including the current salary. Next, disclose foreign assets and income. So if you have got any foreign asset or income, you have to compulsorily disclose. In fact, the return form will also tell you to do it, and don't ignore it. Next, disclose all assets. All assets, I'm not saying income, all assets. If earning is above 50 lakh. Now that assets might have been generated from whatever, but when your earning crosses 50 lakh during the year, then you have to disclose all the assets that you have got. You have to only disclose, there is no further requirement, but don't ignore disclosing assets. Of course, the return also will ask you to disclose it. Then next, file the return before deadline and verify the return. If you are not verifying the return, then that return will be null and void. So see that you are verifying return. And deadline means what? See, now for the current last year rather, the deadline for filing the return, which was actually supposed to be 31st of July, now it is extended to 30th November. But 30th November is a deadline with the last date. It is not the muhurtam. You can file your return even today. If you already fine. If it is not filed, okay, because of the lockdown, you can still file, but don't wait for the last date. And see that in any case, you will not cross the filing of return, because there will be some penalties and other things. And the last from my side, keep your login ID and password confidential. Now, in fact, I don't have to explain. Now, you know, Jamtara will be getting so many calls, and then you respond to those calls, you give your information, all your fund may be washed out in seconds. So don't share with your login ID and password with any unauthorized person. I think with this, I thank the organizers and take your leave. Thanks to everyone. Take care. Stay safe. God bless. Thank you. Over to SEEMA.
SEEMA, you're muted. You're muted. Unmute yourself.
Okay. Thank you, Santosh Ghag, sir, for nice enlightening talk on the today's topic. Thank you, sir. Now, I would request CA Soumya N to introduce a resource person, CA Sagar Jayawant. Welcome, sir.
Good morning. It is my pleasure to introduce CA Sagar Jayawant, sir, to this audience. Sir is a Poda Right, and he is a qualified chartered accountant. He has his own partnership firm providing business consultancy services, due diligence work, corporate audits, and bank audits. His firm is also very well established in the areas of GST, direct tax compliances, and non-resident taxation. Sir has a very long academic connect when he was a professor at Chetna College, Batra. He continues to share his knowledge and practical experience by delivering lectures on a variety of topics such as demonetization, GST, etc. at various forums like those of chartered accountants, business groups, Rotary clubs, and education institutions. He is also a director in few cooperative banks and is a managing committee member of various associations. With this very brief introduction, as permitted by the time, we welcome you, sir, for our webinar. Over to you, sir.
Thank you, madam, for your introduction. And let me thank firstly the organizers, secretary of the institution, Bharat Pathak ji, Nishikant Jha, then all the CAs, Dr. Leena Raje, then Dr. SEEMA SHAH, Soumya N, and with all these stalwarts in the line, I'm slightly afraid. The collective knowledge of all these persons is much, much more than what I might be having individually. But friends, today I'm here to, rather than showing knowledge, my knowledge or something, I'm here just to explain the provisions, because now many of you, even the students of CAs and others, are partially or fully aware of what the provisions are. So we are actually rather going to discuss what are these provisions and what are some of the intricacies involved in the same. So thanks a lot once again for giving me this opportunity. I will now start sharing my screen so that our topic will become much more easy to understand. Those who are having laptops or desktop, I requested to start, because this will involve some amounts and the figures. So generally, on the small screen, it becomes rather difficult to comprehend. So if you have bigger screen, it will be better. Now I have already started sharing the screen. and I hope that it is visible to all.
Yes, sir.
This is our today's topic. Should salaried employees opt for new income tax slab? And this has been organized, as you are aware, of this university and Srimati MMP Shah Women's College of Arts and Commerce. And this is, I have heard that this is autonomous college, very fantastic. And I have also taken their invitation. I have heard it very carefully. And once the lockdown is over, I'm certainly going to visit the college to enjoy the environment and uh, everything that they have. So now let's start with our topic. I'm given about 50 minutes, so I will try to give justice to the topic within these 50 minutes. So our topic is whether we should go for old tax regime or new tax regime. Let me tell you that today's discussion will be more or less restricted for the salaried persons. Although there are only a few provisions related to businesses, we are not going to touch them because I'm aware that the audience viewers are mostly the salaried employees, teaching as well as non-teaching staff. So what has happened in this year that we are going to take up one by one, in order that you have a preview about what's supposed to be taken today. In the beginning only, I will let you know what are the things that I am going to cover, so that this might interest you to sit up to the end of the lecture. First is, what is this optional tax new regime of tax, and since when is this applicable? Now I'm just reading out the points which I'm going to cover. I'm going to explain it in detail one by one as and when we come to that. Then the reasons for such optional tax rates being brought under section 115 BAC. Actually, this particular topic has been very nicely explained by CA Santosh Ghag sir, who was a keynote speaker, and therefore there is hardly anything left for me. And he has explained it so nicely. He has covered all the important points as to what are the reasons. So we may not touch upon this topic in detail now. So comparison between old tax rates and new tax rates. What are these new tax rates that we'll quickly compare? Then which deductions and exemptions are not allowable under the new regime? Exactly, we'll try to understand what is this allowable, not allowable. Is this a new law which is coming into place? Why it is allowable and not allowable kind of thing? Which deductions and set-offs are related to income from house property are required to be foregone? Because it is not only the investments which generally people feel that they are to be foregone, but there are certain other areas also where the deductions are required to be foregone. We'll see that and how it is to be foregone. And then which are the deductions which are continued to be allowed under this new regime also. How to choose between the two different tax slabs. This is our key area for the day. After understanding this concept, we will try to go to the case studies. I do have many case studies. We might go through one or two or three, depending on the time up to which we are getting the time. So, and then we'll come to what is the duty of an employer. Many of you are actually non-teaching staff who are required to do tax deduction at source. So you are an employer as an institution. What is your duty in this new regime? Then we'll also see can this option once exercised be changed? What are the conditions related to that? Are there any thumb rules? Generally, where you can actually be safe, or where you have to apply your mind, where you don't have to worry about at all. So those are the kind of the thumb rules that we will talk about. So firstly, before we go to the old and the new tax rate, let me tell you the conceptually what it means. This year, the budget 20 will talk about the tax rates related to financial 2021. Okay, so budget 19 will talk about financial year 1920, and the returns that you will actually be filing now, the last date which Dr. Santosh Ghag mentioned was 30th of November. So that return which we are talking about is for financial year 1920. So let's not get confused about what we are discussing today and the returns that you'll be filing for the current financial year, that is for the financial year 1920. So in short, the provisions that we are going to discuss today are applicable for financial year 2021, that is for the next financial year, for which you will be filing the return in the 2021, not now. Now the question arises, if that be the case, if I'm supposed to file that return on 31st of July 2021, then why so much early we are discussing all these matters? We are discussing these matters because although we will be filing the returns on 31st of July or before 31st of July 2021, but as an employer, he is supposed to deduct the tax at source from now, because the tax deducted at source for the financial 2021 has already started. Therefore, there has to be some clarity about how much tax is to be deducted. So let me once again try to get into the scheme that we are talking about. This year, that is for financial year 2021, what they have done is that they have given you a different rate of tax. Now, apparently, if you see that rate, which I will show you now, apparently, if you see that rate, this tax rate is lower as compared to what it was earlier. Now, your question will be, sir, if the tax rate is lower, then why we should go for the old rates at all? So what they have done is that they have given you the option to go to this new tax rate, provided you are giving away certain deductions or certain set-offs. Now, therefore, this becomes little complex. If you have deductions and set-offs which you are giving up, and because of that your income is at some level, now there the tax, although at a lower rate, it could be even higher than your old tax regime, where all the deductions, all the set-offs, all the tax-saving investment deductions are available. Therefore, it becomes important for us to know both the things. One, what are the old rates, what are the new rates? Second, what are the deductions or set-offs or investments which are otherwise available to me under the old rates are now not available? And then we'll actually get into the practicalities, because the ultimate aim of this is not just to give you knowledge. Ultimate aim of this session is that all of you, those who are employees, should be able to do this working on your own without going to any of the chartered accountants. You may go to chartered accountants to confirm, but on your own, you should be able to calculate whether you should go for the old scheme or the new scheme. If we are able to achieve this objective during the course of this 1 hour or say 50 minutes, then I would be very happy. So let me now, with this brief background, get into the subject matter very quickly. So we are now trying to see what are our old rates. The old rates, that means the rates that you are following for even financial year 1920. As I had mentioned, these are the only rates that you are following for financial year 1920, which means the return that you'll be following for the current year, you don't have any options. Let's not get confused about that at all. So these are my rates, that up to 2,50,000, you have zero tax. From 2,50,000 to 5 lakhs, we have 5% slab. From 5 lakhs to 10 lakhs, you have 20% tax. And when you go above 10 lakhs, your tax rate is 30%. In order to simplify the matter, I am not separately giving you the rates of the senior citizens or very senior citizens, although they are not difficult. Their slab, basic slab has, instead of 2.5, it goes to 3 lakhs or 5 lakhs as the case may be. But right now, I'm not considering that. I am also not considering surcharge and education cess, because right now we are interested in comparing the two rates. Now, under the old scheme as well as the new scheme, surcharge, education cess, both the things are exactly same. So these are not going to make the difference in our decision making. Therefore, for the time being, for the purpose of our discussion today, I am ignoring the surcharge as well as the education cess. So these are our old tax rates. Now, those who are not from the commerce background, let's say you are from science background, and you are not even mathematics background, because if the mathematics background, if you are having a mathematics background, then you can compute the tax with ease. You can just go to some prepare some Excel formula based on this, and just on the click of a button, you can easily calculate what the tax is. But for those, let's say who are not commerce background, who are not very good in mathematics, I'm quickly telling you how the tax is calculated. Although some of you will feel that it's too simple for them, but let's try to understand so that the topic will become comprehensive and complete. Supposing, let's say, if your income is 7 lakh rupees. So how do you calculate the tax on that based on the tax slab? First, 2,50,000 rupees, there is no tax. Okay, so you are exhausted first in 2.50 lakhs, but your income is 7 lakh. So therefore, you have to go to the next slab. So 2.5 lakhs to 5 lakhs, you are paying the tax at the rate of 5%. So you have to calculate 5% of 2.5 lakhs. So that becomes the tax on 5 lakhs. But your income is not 5 lakhs, your income is 7 lakhs. So you go further. So after 2.5, after 5 lakhs, you have to go further 2 lakhs because your income is, let's say, 7 lakhs. And therefore, on that remaining amount of 2 lakhs, you calculate the tax at the rate of 20%. So, and then when you add these things together, you'll get your tax. So same procedure is followed even when your tax, even when your income is exceeding 10 lakhs. Supposing if it is 12 lakhs, then on the first 2.5, there is no tax. From 2.5 to 5, the tax is 5%. From 5 to 10, the tax will be 20%. And if now your income is 12 lakhs, that means it is exceeding 10 lakhs by 2 lakhs. So that amount which exceeds rupees 10 lakhs, only on that amount, you calculate 30%. You add that together. And then thereafter, you calculate the education cess, which is nothing but the certain amount of percentage, say 4%, on the tax that you already calculated. So this same method will be prevailing even for the new tax regime or the new tax slab that we are talking about. So let me now go to comparative study of what is the new tax slab. The new tax slab is like this. They have made this more number of slabs. What they have done is that up to 2.5, of course, there is no tax. If you see 2.5 to 5, the tax slab is exactly same as what it was for the old tax regime or old tax slabs. Then from here onwards, there is a slight change. You had seen that beyond 5 lakhs, earlier it was directly 20 lakhs from 5 to 10. Whereas here you will see 5 to 7.5, the tax rate is 10%. 7.5 to 10 lakhs, the tax rate is 15%. So definitely there is some kind of a saving at this point of time. And when you exceed 10 lakh rupees, if you compare this with earlier tax slab more than 10 lakh, it was a flat rate of 30%. Whereas now there is one more slab beyond 10 lakhs. So after 10 lakhs, there is a 20 up to from 10 lakhs to 12 lakh 50,000. You have 25% slab, and when after 15 lakhs, it becomes 30% slab. So there are two more slab between 10 to 15. And naturally, if it is going beyond 15 lakhs, then it is a 30%. Before that, it was a 25%. 10 to 12.5, 20%. 12.5 to 15 is 25%. And beyond 15 lakhs, it is 30%. Now, when we compare these two slabs, let's understand, fit into our mind that if someone's income is beyond 15 lakhs, what will happen? So whatever differences have taken place up to 15 lakhs are there. Naturally, the tax rates are lower in the new regime. Therefore, there will be some kind of a benefit. But once you go beyond 15 lakhs, what will happen is the tax rates are 30% and 30% in both the cases. And therefore, beyond 15 lakhs, there will be no difference in the taxation. This is something which we need to understand under both the scheme. Nevertheless, there will be a benefit up to 15 lakhs. And how much will be that benefit? Also, we will see one by one. Now, before we actually go into some more figurative work, let me get into some theoretical aspects. When we talk about old rates and new rates, we must also know that when you are following the new rates, certain deductions and exemptions are not allowed. So the benefit that they have given you is not just like that. Okay. So the benefit that they have given is subject to. What is that subject to? Subject to the fact that if you want to go for the new scheme, certain deductions and exemptions are not allowed. And therefore, we need to know what are these certain deductions and exemptions not allowed. There is an exhaustive list given in the relevant section. So we must know that list. What are the deductions not allowed? Section 10.5, leave travel concession. All of you, maybe in colleges, it may not be much, but leave travel concession is one of the important deductions that every salaried employee gets. House rent allowance, yes, this is also an deduction exemption you will always claim, but this is not allowed. So let us once again clarify. If you want to go for the new scheme, these deductions exemptions are not allowed. If you want to remain in the old scheme, these are still allowed. So there is no complete change in the act. The act has become now optional kind of thing. So there is no complete change in the act. So I'm now going to list down. This is slightly a repetition. Then standard deduction. All the salaried employees are having standard deduction of 50,000. Profession tax we are getting, but when you go for the new scheme, these two deductions are also not allowed. Then we go to standard deduction on family pension, that is parallel to standard deduction, but when you are not an employee, you are getting a pension as a family of somebody who has already died or deceased, then you get this standard deduction. So that is also not allowed. Then all the deductions, this is very sad, all the deductions other than section 80 CCD2 and 80 JJAA are not allowed. So what are these chapter 6A deduction? They are very popular amongst all, where you make tax saving investments, you have this provident fund, you have national saving, you have PPF, your tuition fees, your repayment of house loans, all these deductions, LIC premiums, certain mutual fund investments, these are coming under 80 chapter 6A. And in chapter 6A, in fact, there are, apart from investment, there are many other deductions. For example, you have 80D, where you get at least 25,000 deductions from for Mediclaim. Then there are certain specific deductions for royalties. All those deductions will not be available if you want to go for the new schemes. So this is actually a blow for almost all of you, that if you want to go, here are the areas where we have to see. This is also again another thing, set of loss under income from house property with any other head of income. Many salaried employees, many college employees have bought at least one house from the loan, and they are typically claiming the interest as a deduction, and that negative income which arises out of the interest that you pay, which you declare many times to the employer that this is my negative income from house property. So that gets reduced from your other income, including salaries. This is also reducing a lot of tax burden for the employees, or even for that matter, even if you are not an employee, this deduction is available. But because if you are opting for the new scheme, you are losing this deduction. But here, let me clarify. I'll explain you that to you in the example also. Set off of loss under the income from house property with any other head of income. So supposing if you are having let's say house property, and you have let it out. So when you let it out, let's say, and your rent is 1,20,000 rupees in a year, and you are paying the interest. So this interest payment can be deducted even under the new regime from the income that you are generating from house property. So supposing if the interest is, let us say, 80,000, so there what will happen is that your income from house property is 1,20,000 minus 80,000 of interest. So your negative income will only be I'm sorry, this is your positive income of 40,000. So what's not allowed is the loss which can be set off against other heads of income. Let's extend that same example, and here let's assume that your income from house property which you are let out is 1,20,000, but your interest from that house property which you have taken on loan, and therefore you are paying the interest on the loan, which is, let us say, 1,50,000. So typically what you would normally do is 1,20,000 minus 1,50,000. You have a negative income of 30,000. What will you normally do? You will set off that 30,000. You will tell your employer, my negative income is 30,000 from house property. So employer will adjust this 30,000 rupees against your salary, and then you deduct your tax. So this is a negative. This is this negative income from house property you are setting off against other head of income. Which is that other head of income? It is salary. So this particular aspect is not allowed. So what will happen is that in this current scenario, your income from house property 1,20,000 minus deduction 1,50,000. Fine. Now you want to go for the new regime. Your income from house property, which was negative 30,000, cannot be set off against salary. Does that mean that my 1,20,000 rupees will be charged? No, because you're already paying the interest of 1,50,000 rupees. So that from that 1,20,000 within the head, you will get the deduction. But or even for that matter, if there is other income from other house wherein you are getting some income, even against that also you can deduct your negative income. So if you are having two house properties, here there is a negative income of 30,000. So both the house properties you are having, let's say, some kind of income. Here there is a negative income of 30,000, and another house property you have positive income of 40,000. So you will be able to set off this 30,000 against the positive income of 40,000 from your own another let out property. Therefore, your income will become 10,000. Okay, so this is allowed, but you cannot set off a negative income remaining in the house property against the other heads of income if you are going in for the new regime or the new tax, new optional taxes. Then all the special allowances other than conveyance for official duty, transport allowance to blind, deaf or dumb, other than these 2 or 3 allowances, you have all the other allowances of conveyance of official duty. These are not allowed. Okay. Then all special allowances other than allowances for cost of travel on transfer, this is otherwise allowed. But if you go for the optional scheme, then these expenses are not allowed. Daily expenses incurred for absence of normal place of duty, so on and so forth. Now we'll see what are the deductions and exemptions are allowed. Now please remember that whatever is specified in deductions allowed, anything other than that, other than what is specifically disallowed, other than that everything is allowed. So the examples which I am giving you now is not the exhaustive list. What was the exhaustive list? Exhaustive list was earlier. What is not allowed? So therefore, these are just illustrative in nature. So if you have when you want to see whether something is allowed or not, you will have to go to a section and see what is not allowed. So what is not allowed, if you are coming into that list, then it is not allowed. If it is not coming in that list, then it is allowed. So I'm giving you an illustrative examples of what is allowed. This is not mentioned in the act, and these are just the common examples which are mentioning. Gratuity, this is still exemption. So that exemption they are not taken out. Leave encashment in some typical cases. It's not that all leave encashments are tax-free, but they are specified certain circumstances under which leave encashment can be claimed exempt. Then you have commutation of pension if provided certain limits are met. Then you have retrenchment compensation. These are existing exemptions, and what I'm trying to say that even if you go to the new regime, these exemptions are still continued and they have not taken away your right of claiming this exemption. So then withdrawal from NPS, withdrawal from recognized provident fund, some received under maturity of LIC. See, for each of them, there are certain conditions which I'm not discussing right now. Those conditions are mentioned over there. For example, some received under maturity of LIC, there is a condition that your premium amount should not exceed 10% of the maturity amount. So if your premium itself is so big that you are paying, let us say 20,000 each year, and your maturity value is 1 lakh. So now your premium amount, let's say, is more than 10% of the maturity amount. Under these circumstances, your sum received under maturity of LIC is otherwise also not exempt. Okay, so we are not saying whether old regime or new regime. Here it is not allowed because of the original section provides that under certain circumstances, sum received under maturity of LIC is not allowed. Okay, so you have to see the conditions before we actually apply these exemptions. Non-monetary perquisites paid by the employers, these are also exempt, but and this exemption continues. Then standard deduction on rent. If you are let out house property, you may be aware that you are getting 30% deduction. Of course, this has nothing to do with the salary, but why I've taken this, because most of the people are having some or the other house property. Sometimes they are let out, sometimes because you are having more than 2 properties. Remember one more thing, one important change which has taken place in the budget of 2019 is that earlier you were allowed to have 1 property, self-occupied property, whose income is to be taken as nil. Supposing if you are having 2 house properties and both of them are self-occupied, as per the earlier law, you were supposed to have second property to be considered as deemed to be let out. So even if you are not actually let out, you will have to consider how much rent it would have accrued or you would have received from that property and include that rent into your income, even though you are not actually receiving any kind of a rent, and pay the tax on that. So that was applicable from the second property till financial year 18-19. But from 1920, there is a good solace. They are saying that you can, from the financial year 1920, that is the return that you'll be filing, even if you are having two house properties, self-occupied house properties, you will be not charged to tax. So if there is a third house property, then that third house property, and if it is a self-occupied house property, it will be considered to deemed to have been let out, and then you have to pay the tax on that, even if you are not actually let out. So if you are actually let out, you are getting a standard deduction of 30%, which is still continued. Payment from approved superannuation fund still continued. Employer's contribution under 80 CCD2. Now, this is there are only two sections where under chapter 6A where the deductions are continued, and this is one of them where employer is contributing towards the exam. Now, so far as the college employees are concerned, you are not coming across this deduction, because your contribution by the employer is probably determined not by you but by the government. I'm not sure autonomous colleges can decide something about the structure of the salary, but I feel that they cannot. But this will more or less happen with the private companies, where the employers are interested in giving more benefit to the employees with lesser tax. So this was the section which is being used by so many companies, where amount of 50,000 over and above your deduction of 1,50,000, you are getting the deduction, although employer is contributing into your account. So this 80 CCD2 is still continued. All other deductions, even 80 CCD 1B, is also not allowed under the new regime. So this 80 CCD into bracket 2 is something which continues. Then all the exemptions related to capital gain, 54, 54B, 54D, 54E, of course, they are not related to salary. Why I'm taking it? Because many of the salaried employees, they invest in the share, they purchase a house, sometimes they sell, and these, therefore, they somewhere or the other, they do come into contact with these kind of sections when they want to file their returns. Then we are continuing with this, and we are going a little fast because I have to spend a little more time on case studies. So section 1010C, compensation on voluntary retirement, set off of loss within the income. I had covered this point earlier when I said what is not allowed. Set off of loss within the income from house property under the same head of income. Just to explain once again, because here many people get confused. I am having two house properties. One house property, there is a profit. Another house property, there is a loss. I can set off the profit from one house property against the loss from other house property, even under the new regime. What is the provision says that if under the head income of house property is negative after giving internal set off between that head, if that is negative, that cannot be set off against the salaries. I am repeating it again because sometimes this confuses people. So that was it. Then conveyance for official duty, transport allowance to blind, deferred allowance. So this has still continued, because other transport allowances which were there, they have been now done away with when they introduced standard deduction. They have done away with this normal transport allowance which you people used to get as exempt normal persons. But for the deaf and dumb, that 3,200 rupees per month, they have still continued. And now under the new regime also, if such kind of a person wants to go for the new regime, still you will be able to claim that deduction. Then allowance for cost of travel to transfer journey, excess transfer daily expenses incurred for absence from its normal place of duty is still allowed. Now, so we have quickly seen earlier the list of deductions which are allowed and not allowed. And once again, let me tell you what is this allowed and not allowed. Under the old scheme, you continue to follow exactly what you have been doing in the current year. Under the new scheme, you get benefit of the lesser taxes, but give away certain deductions or allowances or set-offs. Now, this is just a comparative table as to exactly how much tax is there. We have seen the tax slabs, no doubt, we have seen the tax slab. But if I have to actually get into the slowly amount wise or figurative, exactly how much difference there is in the because unless and until we understand this difference between the amount or the quantum of the difference between the old slab and the new slab, we will not be able to comprehend how to take the decision. I will also help you to take the decision whether I should make the investment in tax saving bonds and get some benefit, or I should not make the investment and actually opt for the new regime. That is something also you'll learn by the end of this session. So now, before we go and get into that, I'm just trying to compare here as to what are the taxes applicable under the old scheme and the new scheme. Just try to pay attention. I'm aware that concentrating for a longer period in mathematical things or figurative work is slightly difficult. But remember, this means money, and when it means money, I'm sure that you'll be spending more than 1 hour also with me, because this means that you'll be able to save some money. Any money saved is money earned, and I can tell you that theoretically you can spare, you can actually save to the extent of 75,000 rupees by way of taxes if you choose the right method, new or old, or by not choosing the right method, you may lose 75,000 maximum. So now we are trying to compare. If your tax was 5 lakh rupees, then under the old scheme, your tax will be 12,500, and your tax under the new scheme is also 12,500. What I'm trying to say is that if your income is below 5 lakhs, up to 5 lakhs, then there is no difference in the old slab, so there is no difference at all. Now I'm taking representative slabs of 7,50,000. So if you are 7,50,000, under the old tax slab, your tax will be 62,500, whereas the new tax slab, it will be 37,500. Why there is a difference? As I had mentioned, that the tax slab itself has changed, because instead of 20%, we are applying 10% other than the rate. Therefore, there is a gain under the new scheme of 25,000. If you go to the 10 lakhs, then the tax under the old scheme is 1,12,500. New rates, it will come to 75,000. So your gain is 37,500. Now remember that this 37,500 is not in addition to 25,000. What I've done is here is that if your tax, your taxable income is 10 lakhs, then the tax difference is 37,500 totally. So this 37,500 includes 25,000. Okay. Then let's go ahead. If your taxable income is 12,50,000, then your tax is 187,500. Here it is 125,500. So you are gaining 62,500 by choosing the new tax slab, optional new tax slab. And if your income is 15 lakh, then as per old tax rate, your tax would have been 2,62,500, and new rates it would have been 1,87,500. So there is a gain of 75,000 by choosing the new rate. But this is just a theoretical, because I just tried to do a mathematical calculation. This will not actually apply practically, because we are not comparing taxable income of, let's say, 12,50,000 and taxable income of 12,50,000 under the new scheme, because the moment I say new, I am applying the new rates, you will have to give away certain deduction. So your income will never be same, and therefore this comparison is only a theoretical comparison. What you will have to actually do is to find out what is my taxable income under the old scheme and what is my taxable income under the new scheme. Then only you can actually find out the tax and actually find out the difference. But yes, this is just for the mathematical purpose that we have tried to show. Now, this is again another mathematical comparison where I'm trying to show you as to how much investment we can make so that my two schemes are in equilibrium. For example, let me tell you what I'm trying to say. If my income is, say, 6 lakhs, okay. Now, naturally, my new slabs are lower. So if I have to pay the same amount of tax, then I have to make an investment or the deduction, allowable deduction of 50,000. Then I'm in equilibrium, which means that my tax under the old scheme and the new scheme will be same. But under the old scheme, I will have to make the investment of 50,000. Under the new scheme, I don't have to make the investment of anything, but still my tax is 22,500. Why I'm trying to show you is because supposing, let's say, if you are making the investment which is more than 50,000 at this point of time, then possibly, this is not an example which I'm giving right now, I'm not taking case study, then possibly if you are making investment of more than 50,000, then you might end up paying lesser tax under the old scheme. This will be more clear with the case study. So 7 lakh rupees, let's say your income is 7 lakh, then you have to make the investment of 1 lakh to come to the new scheme, and the same tax of amount of payable. So if you make the investment or deductions which are allowable are more than 1 lakhs, then only the old scheme will become comparable for you. Why I'm giving you this table is because few people may be having, you can actually in your mind, you'll start working on exactly in which slab you are falling into. So if you are, let's say, falling into this 7 lakh slab, and if you are unable to make the investment of 1 lakh rupees, then there is no point in going for the old scheme. Then you can always go for the new scheme. But if you are possibly making, you are in a position to make more than 1 lakh rupees investment. Now this 1 lakh rupees investment includes all your provident fund, which are directly deducted, then your standard deductions, then your profession tax, and so on and so forth. So everything included, if it is exceeding 1 lakh rupees, then you can actually start thinking, otherwise don't think. Okay, so this I'm trying to simplify the matter. What is not relevant for you, what is relevant for you. Otherwise, if you try to learn everything and all complexities included, no, you'll not learn anything. Therefore, I'm trying to simplify as much as possible. So let me directly jump to the 10 lakhs. So if your income is 10 lakhs, then if you are making the investment of 1,87,500, then only your tax payable will become same, and that is 75,000. When you go to 11 lakhs, the same similar explanation. When you go to 12 lakhs, similar kind of explanation can be given. When you go to 13 lakh, you have to make an investment of 2,16,667 to get the benefit, which is equivalent to the same tax under the old scheme and new scheme. Now here, some of you might ask me a question, sir, the deduction which is available under chapter 6A is only 1,50,000. Then why are you showing us 2,16,667? I am not able to get any benefit beyond 1,50,000. So where is the question of 2,60,000? You should have stopped at 1,50,000 and said, "Boss, this is over." Remember that. Let us try to change the concept. It is not only investment that we are talking about. Investment under Section 80C is only one aspect of the allowable deduction. We have seen the list of various other deductions which are also not allowed, and one of the important ones was income from house property, which is also not allowed. Then you have mediclaim, which is also not allowed. So if you add all of, you are aware that from income from house property, negative income otherwise is allowed up to ₹2 lakh every year. Okay, so even if you take 1,50,000, which is 80C limit, then minimum another 25,000 rupees. Of course, it is a senior citizen, then you will get more deductions under 80D also. But let's say 25,000 under 80D, that is for mediclaim. So 1,50,000 plus 25 becomes 175. Plus, let us say you have got a big, huge house and you are paying the interest. So your 2 lakh rupees interest is definitely there per year. So 2 lakhs plus 1,75,000, that becomes 3,75,000. Plus there could be some other deductions under chapter 6A. So this amount can exceed 1,50,000. Plus you have got a standard deduction, you have got profession tax. Therefore, please don't think that this is only chapter 6A that we are talking about. Let's go ahead. So 14 lakhs income, you have to make the investment deductions of 2,33,000. 15 lakhs, you have to make the investment of 2,50,000, and your tax will be 187,500. Once again, finally, let me explain you what I am talking about. If your income is 1,50,000, okay, and if you are making a tax saving investment or allowable deductions are 2,50,000, then your tax under old scheme or new scheme is exactly same. And how much tax you will be paying? You will be paying 1,87,500. If you don't make this investment of 2,50,000, when your income is 15 lakhs, then your tax under the new scheme will be better because you are not making this investment. You will be you will be paying the same amount of tax under the old scheme only when you are making the investment or your deductions, allowable deductions, are of 2,50,000. In other words, if your deductions are more than 2,50,000, you can always go for the old scheme when your income is this. Okay, so that was just a comparison between the two. Now, I'm now coming to more practical examples. This is somehow typically a salary slip of employee working in colleges, schools, institutions will be like. Now, what you are supposed to do, because I had mentioned that my objective is that to enable you to do the calculation on your own. I'm sure that most of you, or at least many of you, are aware of how to use the Excel for simple sums, additions, deduction, multiplication. Use that Excel, you'll get the answers very easily. So all that you have to do is to take your salary slip, because we are talking about 2021. Now 2021 form 16 is not ready. So how will you know the amount? You will have to take the salary slip from your colleges, and you will get the breakup. Primarily, we are more concerned with the gross amount, but this is a breakup, just if you want to see how much the salary is being paid. So you write down it in this manner: April, May, June, July to March. So maybe it may so happen that generally you may be getting some kind of increment in a particular year. Every year you will get at least one increment. So all that you have to do is you might have to include list down your salary in this manner, and wherever there is an increment, this increment can be added. Now, for example, here if you see, I added this increment somewhere in the month of July. So there is an increment. So after that July, the amount of salary again has remained same. So that I have got the total amount of 18,33,111. Now, what is this 18,33,111? This is a gross salary which you are likely to earn during the financial year 2021. So this becomes your basic data. Every one of you must have this data if you want to do the calculation on your own. Without this, you cannot do anything. Okay. So firstly, you do this, multiply this by 12. If there is an increment, add that, you get the data. And then prepare a sort of a small computation. How will you do that? You will have to do, you have to gross salary or gross income remains same. Now, under the old scheme, you will get standard deduction, you will get profession tax. Under the new rates, what you will be doing is that you will be writing 0 over here. Why? Because this is not allowed. Okay. But so here you are reducing, here you are not reducing. But I am writing it in front of each other just to know how it makes the difference. So then let's assume here that we are having house property loss. So that house property loss you are getting here, but you are not getting under the new regime. So on the left hand side, if you see old rates, I am reducing all the amount, whereas on the right hand side, I am putting 0. Now, if there is other income, now that other income will be added in both the cases. So supposing if you are having interest income, you are having examination remuneration, so that will be added in both the cases. So I am adding here. So it is becoming more practical for the persons who are working in the colleges. And then your deductions. See, generally, if you are having 10, 12, 13 lakh rupees of salary or 15 lakh rupees of salary, generally people do invest up to 1,50,000. So therefore, I have taken 1,50,000 over here. Then everybody generally has claim. So I have taken that 25,000. In your case, supposing if it is less than 1,50,000, you put the actual amount that you will be investing in, and you are aware of, you already inform your employer about it. Then this interest which you have added here, supposing if it is a saving bank interest, and then you are getting deduction under section 80 TTA, so that amount also gets reduced over here. But here you will not get that deduction because it is coming under chapter 6A. So this is also very important. Here I have added, but here you will not get the deduction under chapter 6A. Then after this, there is a simple mathematics for the calculation. I have already shown you that which are also available on the website or income tax site. What is the tax slab, old slab? And so on 158,061, 185,111, you can calculate what is the tax which is allowed, what is the tax which is applicable, and compare that. So this is one of the simplest method of comparing the two things. This is, anybody should be able to do in this manner. Now, where the complexity is, here I have considered the maximum limit. I have made some investment. The complexity will start where I have not made the investment. I have made only investment of 6,000 rupees. Now I have to make the decision. Should I make the investment and save the tax, and how much tax I will save? So that I'm going to take up in the next case study. But for you, supposing if your investment is fixed, you have already decided, irrespective of whatever is the tax slab rate. If you have decided this much investment I am going to make, this much calculation is sufficient for you. So I'm trying to simplify, I'm trying to take away one by one the complexities involved into that. So half of the people will say, yes, boss, I don't want to take many investment decisions. I am going to invest 1 lakh rupees, 1,50,000 rupees. I am going to take up Mediclaim, and nothing is going to change because of old slabs and new slab. Then this calculation becomes the standard calculation for all of you. Take the salary slips, actually calculate and apply it with this simple method of calculation. Then now I am taking another case study. Now, based on what we have done, I have tried to reduce the number of items. So here I am going to take how much investment I should be making. Now, as I said that earlier, I have just done the calculation. Now I am trying to understand, I have got an opportunity. Up to what date you have to make the investment? You have to make the investment up to 31st March 2021 for the next year. And many of the chartered accountants in the month of December, January, February, clients do approach them, and therefore we know exactly what is your anxiety. They ask questions, how much I should invest in order to save how much tax. Because if you are getting some absurd figure like by investing 2 lakh rupees, I am saving a tax of 5,000 rupees, then better you don't invest. Enjoy that money, or you may invest that money into some other more return giving investment. For example, you can invest in safe mutual funds and get more returns rather than locking into the tax saving investment and getting the less results. Therefore, we are supposed to know as to exactly how much amount I should be investing and how much how do I come from old scheme to new scheme, and how much more I should invest so that I'll get the tax benefit, and how much tax benefit I'm going to get. So first of all, what we are supposed to do is that whatever is your income, if there are any items where deductions are allowed, then you deduct them first. Now, hardly there are any deductions where deductions are allowed. We have seen the deductions could be your gratuity, then retrenchment compensation. So those kind of things which are allowed, you first reduce under both the scheme, old rates, because they are allowed. Therefore, I'm trying to bring the equilibrium, and then I'm able to take the decision. After this, I find out the net taxable income, and I have to play on this figure rather than the amount which is given over here. Okay, so on 7,70,000, I have to take the decision. Now, after 7,70,000, I will calculate the tax, how much tax is payable. Okay, see, earlier when these two tax slab methods were not there, it was a very simple calculation. What we used to do, supposing if somebody comes to me and asks me how much investment I should be making in order to save the taxes, then I have calculated, let us say 66,500 as a tax. Now I'm not referring to the new rates, I'm referring only to the old rate. So in the current scenario, what was happening? Okay, your net taxable income is how much? 7,70,000. Fine. That means you are in which tax slab? You are in the tax slab of 5 lakhs to 10 lakhs. 5 lakhs to 10 lakhs. Your tax amount, tax rate is 20%. So after this, whatever investment you make, you will be saving 20%. So for example, if you make the investment of 1 lakh rupees, you will be saving the tax of 20,000 rupees because you are sitting in the 20% tax slab. So after, therefore, out of 66,500, you will be saving the tax of 20,000. You will be paying only 46,500 if you make further investment of 1 lakh. That was simple calculation that we used to make earlier. Then a person will take a call. Okay, my 1 lakh rupees are getting locked for 3 years. Is it worth saving 20,000 rupees, or I should invest those 1 lakh rupees in some other income giving investments which will give you more investment, more returns than what this tax saving investment will give. So that was our earlier calculation. But now I am bringing in another parameter, that is a new tax slab. And therefore, without looking at this new tax slab, I cannot take that decision. And how to take that decision? So I go further and find out what is the difference between the two. So now the difference between the two is 26,000. Okay. So now, therefore, I have to consider like this. Here I am sitting in 20%. Okay. And 26,000 is the difference between these two. That means if I have to go even from old rates to new rates, okay, I am already getting a benefit of how much? 26,000. What is this 26,000? 26,000 is a benefit in the new scheme. Now from old scheme I have to go to new scheme. That means firstly I will have to compensate this, and then I have to see whether I can make further investment. How do I do that? I'm sitting in 20%. Therefore, in order to compensate or nullify the effect of this 26,000, I have to ask a question. 26,000 is 20% of which amount? How do you do that? Simple mathematics. My tax slab is 20%, so I do by 26,000 multiplied by 100 divided by 20. So I get an answer 1,30,000. So what is this 1,30,000? 1,30,000 is nothing but the amount if I invest, then I will be now on par with the new rates. If I do less than 1,30,000, I am not on par. My new rates are better. Okay. Now, if you make 1 lakh more than 1,30,000 investment, then possibly your tax will be lower under the old regime. But then, what has happened? That 1,30,000 itself has become a big base now. Earlier, 1 lakh investment would have made a difference of 20,000. But now, 1,30,000 itself is not making any difference to me. So anything above 1,30,000 will start making the difference to me. Therefore, what's happening is that your investment in tax saving has become probably less and less lucrative at this particular point of time. So once you take that decision, अच्छा उसमें क्या है कि 1,30,000 is the investment which is already which you have to make. But most of the cases you already have this 50,000 standard deduction, provident fund. So you have to also consider exactly how much already going simultaneously without even your intervention, and then you come across the amount of 80,000. That is a further investment to be made, and if you are making that further investment of 80,000, your taxable income under the old rates will become 6,40,000. Under the new rates, it will become 7,70,000. No other deductions are available, and therefore your tax will be exactly same. So in short, in this particular case, if you are making not 1,30,000, 1,30,000 was correct. But now that you are already having that 50,000 rupees as your investment already made, so your net amount of investment to be made to come from old scheme to new scheme was 80,000, and further more than 80,000, it will be beneficial for you. If you are having money, then naturally you can do that. Now, the tax slab which we had considered earlier was 20%. Here I am considering a tax slab of 30%. Now you have to see the tax slab as per the old rates, not as per the new rates. Okay. So here the same thing. Firstly, the method remains same. Find out gross total income, reduce the deductions which are available under both the schemes. Then you come to the taxable income. So this is your taxable income. Then separately you calculate the tax on that. Find out the difference. Ask a question, which tax slab you are sitting. I am having, say here, taxable income is 1266. That means I am between 10 to 15. 10 to 15 is 30%. Then that means I have to apply this 30% slab and come across a situation from going from 300, which is the difference between the two, the benefit between new and old, and applied that 30% tax slab, and I have got the answer 2,11,000. Supposing if I already made investment of 50,000, see many people may be having the loss from house property itself as 2 lakh, so they don't have to really bank on making of investment from 2,11,000, but 2 lakh already made. Here, let's say 50,000 already made. So here this person has to make the further investment of 1,61,000. It is similar example I have taken, but the tax slab was different, just to show that 30% was the applicable rate. Now, so now having understood these two basic examples as to how you should be taking the decision, I'll take only one more example and then I'll go to some more procedures related to this so that we can finish the things in time. Otherwise, we could have taken different examples. I'm just running through those examples. PPTs will be available afterwards. You can study those. Here, the difference is 69,000. The only difference I have made here is that already I am having 2,52,500, which is more than the investment required to be made by me. So here, I have already made up that 2,30,000 investment. Therefore, any further investment, now actually I have made more investment by 22,500. So any further investment will definitely give me a benefit under the old scheme. Therefore, you can, if you are having money and if you are, investable surplus is more, you can, and your tax, that 1,50,000 limit is not yet over, then you can go for this, or you can actually invest in that national pension scheme, which is allowed under old scheme, up to 50,000. Remember that 50,000 is over and above 1,50,000 limit. Many people are not aware of about this, but you can invest up to 50,000 rupees and save the tax. So if you make the investment which is more than any further investment, because this person has already made the investment of 2,30,000, that is 2,52,500. Any further investment will save him, and therefore this person can definitely go for the old scheme. Okay. So here I have shown the equilibrium. So after making that 2,30,000 investment, how much is the tax? More than 2,30,000, the old rates will be better. So in short, old rates are generally, you can say they are better when you are having the investable surplus in your hand. If you are not having investable surplus in your hand, if you are somewhere in the range of 10 to 15 lakh, or maybe 7.5 lakhs to 15 lakh, you are not investing anything, then generally you can say that you should be going for the new slabs. And in fact, that is one of the reasons why these new slabs have come. Although Dr. CA Santosh Ghag has covered all the points, this is one more point which I would like to draw. What happens is that my income is 15 lakhs. My friend's income is also 15 lakhs. Okay. Now, my friend is, having, let's say, brother, sister, everybody is earning, father, mother, everybody is earning. So what's happening is that this person is able to make purchase new house, claim interest. He can invest 2 lakh rupees in a year, so claim all the benefits. So what's happening is that his taxable income, although his and mine is same, 15 lakh, his taxable income is going down. Whereas, let's say I have dependent, I have father and mother, and nobody else is earning. So what's happening is that all 15 lakh rupees I'm spending on them. I'm not making an investment. So what's happening is that I'm paying more tax. So if my liquidity is less, I am not that much rich in that sense, I am becoming further poor. Whereas a person who is already rich, already well off, by paying, he's paying lesser tax and he's becoming richer. So this is another anomaly which was haunting the tax authorities all these days. So they have given you option. Boss, you don't want to make investment? Fine, I'm giving you the benefit. You claim this lower rate. If you have money, okay, invest me, go for the old rates and pay little higher tax. Still, there will be some kind of an equilibrium. So they have tried to bring these two people together, a person who can make the investment, a person who cannot make the investment for his own limitations or the responsibilities. So this is another example. I think this would be a more or less like a repetition, and therefore I am not taking it in detail, but similar way it has been calculated. It was more than 15 lakhs. So that kind of a scenario. Now I am going to some more examples, which are, each example which I have taken have got somewhat different from the earlier example. But, in this 1 hour, I don't think we should be going into the details of all of them. I would only like to show you one important thing related to income from house property. Here there was an income self-occupied house property loss, and we are not able to claim under the new scheme. That is what I had mentioned you earlier, and therefore your income under the new scheme is different, and old scheme we are trying to get 30%. The method remains same, but here I have tried to show that self-occupied house property loss is not allowed under the new scheme to be set off. Although that loss is there, but under the old scheme you can do, new scheme you cannot do that. So the calculation remains same. Now I also talked about the inter-head adjustment. Just bear with me for 2 or 3 minutes. This is an important point. I already explained, but let me explain this once again. Here what has happened is that I have got let out house property 1. Here I have got let out house property number 2. In the let out house property number 1, I have negative income of 15,000 because of that. No, first is a self-occupied house property, so there is a negative income of 1,40,000. In the second case, there is a negative income of 1,80,000. Okay, but there is also some income from the second let out house property. So the net effect becomes 2 lakhs. Now, when I'm applying old schemes and new scheme, what's happening is that under the old scheme, although there was a 2,40,000 rupees of negative income, according to the changed provisions of income from property, I can take only negative income up to 2 lakh rupees. So here I have written 2 lakh rupees in negative income. But when I go here, I am not able to claim anything, and therefore there is a huge loss under the new scheme. So if you are sitting with that kind of interest, negative income, then there is always a possibility that old scheme might be better. If you are not having interest income, only investment income, there are less chances that you might be better off. So you check that. These are all some of the thumb rules. Although you have to actually do the calculation, you can't just go by the thumb rules. But generally, you can come to the conclusion in that way. Okay. So here also the difference was minus. So what has happened here over here is because of this excess deduction, huge deduction which was available, my taxable income had already come down to such an extent that the existing tax itself under the old scheme was lower as compared to the new scheme. Therefore, any further investment made by me will always be beneficial. In any case, I have to choose the old scheme only. I should not go for the new scheme. Even if I am not making any investment at present itself, by doing nothing, I am better in the old scheme. So this was the different case study. Now I am quickly coming to within the given time available. I am quickly coming to the procedural aspect. What I am supposed to do? I have to give the intimation to the income tax department. Now, what kind of intimation? What which type of scheme you want? Every year, so salaried employee, if you are not every year, you have to give the intimation to the income tax department before filing of income tax return that whether you want to go for the old scheme or the new scheme. If your income does not include just a moment. So for the income tax department, you are supposed to give the intimation before the due date, before the filing of the return. So you have to file the return in time. That is first important thing. If your income does not include income from business or profession, you can do it while filing the return of income. This option has to be exercised every year by the salaried employee. Such person can withdraw any number of times in the subsequent year if your income does not include business income, which means that supposing today you have gone for the old scheme, today means current year, that is 2021. Next year you have gone for the new scheme. Again, next year you have gone for the old scheme. That is possible so far as the employees or the persons whose income does not include business income. But if it includes business income or profession, now you will ask me how our income will include business or profession. Now, Ghag sir and all the chartered accountants and others also who are writers getting royalties, all this income comes under the business. So for them, there is a different provision so far as the intimation is concerned. They are saying that if you are under the old scheme as of today, you can go to the new scheme. Once you go to the new scheme, thereafter, you can come back to the old scheme only once. Okay, either you remain in the new scheme all the times, or you can come back to the old scheme once. Once you are in the old scheme, you can never change. This is the provision if your income includes business or profession. Now, what happens supposing if I have business income in the current year? So I have changed it. I have come back, and you are saying that it will become lifetime. But now next year, my income does not include business income. Then do I have this limitation just because at some point of time I had a business income? Answer is no. Your compulsion of not coming back or not being able to change the option is only if your income includes business income. So now if it doesn't include, you again get the options, whatever options you are available, that is going to old scheme, new scheme. But the moment you have this business income and you are continuing to have the business income, you can exercise this option only once. That means you go out, and after going out, you can come back only once. Coming back means coming back to the old scheme. And once you do that, and if your business income continues, you have to mandatorily opt for the old scheme forever. So thereafter, he cannot change. Now, one last important point about the employer and employees. What is happening is that TDS is to be deducted. How the employer will know which scheme you are going to get, whether it is old or the new, employer will not know. Okay, because that option you are going to exercise only at the time of filing of the return. But TDS is to be deducted, and TDS calculations will be different under both the scheme. So they have come out with the circular C1 of 2020. They have said that every employee is supposed to give. Now employer will come out with some. Now university has also given them the standard format, the intimation to be given to the by the employee to the employer. They have to opt, and they will give you some time. In fact, because of the lockdown, the time is extended. Next year, you will find that the time will be something like June only, before 30th of June. But now there are some colleges, maybe universities, they are giving more time. Even that time has not exceeded. Some colleges have given 31st of August. Some colleges have given 25th of August as a time to select as to how much, whether you are going for the old scheme or the new scheme. So you have to give the intimation to the employer that which scheme, old or the new, you are opting for. The moment you give the option to the employer will go accordingly. Now, what happens if you don't give anything? Then the employer has a right to presume that you are in the old scheme only. Okay. So therefore, what we are trying to say is that if you want to opt for the concessional slab, then you have to give the intimation. If you want to remain in the old slab, you may not give the intimation, or if the employer does not get the intimation, he will apply your old rates only. Okay. But however, practically, if you see that everybody will have to give the intimation so that the college authorities or the employer are also clear which scheme you are going. Now the question arises, in the month of August, I have decided I will go for the new scheme. Thereafter, I have got some money. Now I want to invest, and now I find that remaining in the old scheme was better for me. Can I change that? Okay. The circular says that whatever option you have given to the employer once, that cannot be changed during the year. That will remain same because TDS calculation is already done. Employer cannot keep on changing your calculations again and again. Therefore, that has to be first properly decided, and you give it. Now the next question is that, okay, fine, I let my employer not change it. But supposing if I have given the option to the employer that I want to new scheme, but at the time of filing of return, can I change that option for the income tax purpose? Answer is yes. You can change that option. Although you have given the option of new scheme, you can, at the time of filing of return, you can still go for the old scheme. No problem at all. Your calculations will be different. Then accordingly, you will get the refund, or you might have to pay or something like that. Or to your employer, you have given the option of old scheme. But later on, you find that it was not possible for you to make the investment. The employer has deducted according to that, but it was not fruitful. So at the time of filing of income tax return, you can still go for the new scheme and make the necessary changes. But then what will happen is that the tax which the employer has deducted and the tax that you will actually be paying will be different. So there will be either payable, or it will either be refund kind of a case, rather than no refund or no payable kind of thing. So practical tips are that every employer must give some deadline, and they must mention that you have to give the intimation within so and so time, whether you want to opt for old scheme, not old scheme, but still you please give us the intimation in writing. Don't say that just because Income Tax Act has provided that if you don't give the intimation, it will be presumed to be the old scheme. Don't depend on that. For all employees, the employer must have this kind of a declaration so that there is no confusion. It's not something like you lost that paper and therefore I thought this, I thought that. No, nothing. For employee, you must make sure that if you are opting for the new scheme, you give the declaration, take the stamp, official stamp, so that there is no confusion whether you have given, not given. For employer, they must also make an official circular, and they take the declaration. The HR of the college must make sure that all the employees' intimations are in place and very much within the time. Otherwise, your TDS calculation will go haywire and you will have nightmares. It will be very difficult for you to calculate TDS every now and then. Asking you thumb rules. If your taxable income is less than 5 lakhs, do not bother. If your taxable income is more than 5 lakhs, you can bring it down to below 5 lakhs, making small tax saving investment. And because there is one deduction of 12,500, which I did not mention, but supposing if your income is more than 5 lakhs, you don't get that deduction. But if your income is less than 5 lakhs, then you get a total deduction of 12,500 under section 87A. So if your income is marginally more than 5 lakhs, okay, you can make a small investment of even 10,000. You bring it back to below 5 lakhs so that you can save the tax. Even 1,000 investment, making your investment which was just above 5 lakhs to below 5 lakhs, you'll straight away get the deduction of 12,500. Thirdly, if your taxable income is above rupees 15 lakhs, then allowable, and you are making sufficient investment of at least 2,50,000, then you need not generally bother about old schemes and the new scheme, because whatever investment you have made, that is already compensating the difference of 75,000. So if you have made an investment or deduction allowable of 2,50,000, your income is above 15 lakhs, then you need not bother about this, much bother. But those other people between 5 lakhs and 15 lakhs, those people will have to do the calculation meticulously. And I have tried to explain all the intricacies related to that. And I'm sure that, all of you will now be able to do some kind of a mathematics when you go home, or rather you are already at home. This is the way you used to say, go home. No, you are at home. So after having your lunch or something, you try to calculate how much is your tax slab, and once you get the exact details of the monthly tax slab. So thank you very much. These are my contact details. Of course, I have tried to complete it within time. I hope that you have liked it. Once again, thank you all of you for patiently hearing, listening. More than 1,000. It is really pride for me. Thank you very much. If you are having any questions, you can ask me. I am there available.
Yes, Soumya ma'am.
The superb presentation.
So I will stop sharing my screen so that it will be easier for you to be on.
As of now, there are no questions in the chat box. I request the participants, sir, I don't think there'll be any questions because we explained it so well.
Yeah, sir.
So congratulations to you, sir.
Thank you. Thank you. I have tried to cover almost all the points, but still, yes.
Yeah.
It was very good. It was wonderful. It was exhaustive. And within such a short time, only this much can be expected. I don't think anybody can expect beyond this.
Excellent comparative analysis to choose for the new and the old scheme. It was a really enlightening one with the case studies and the thumb rules which you have put in. I welcome participants to put the question and answers in the chat box, and related to today's topic and relevant questions will be immediately taken up.
Sir, there's a question by Ashwini ma'am. Is there any difference in the old and the new tax regime for long-term capital gain and short-term capital gain?
No, there is no difference. There is no difference at all. All the provisions related to old short-term capital gain and long-term capital. See, other than the deductions which I already mentioned, listed, which are also available under that particular section which I had mentioned, there are no changes at all. So long-term, short-term capital gain is a totally. I have mentioned even the exemption done under the capital gain, house property deductions, those are continuing. Thank you. Any other question?
No, sir, yet not. No questions.
In fact, to add to that, sir has already covered.
Yes, so one more question is
just to the same question, just to add to that.
Yeah, go ahead.
Actually, the real difference between last year's tax regime and current year's tax regime is that if you have an income up to 5 lakh, then there is no tax, whether you make deduction or not. But then once you cross 5 lakh, then the difference starts. Then of course, sir has already covered, but since the question has already come, just to add to it. Earlier from 2,50,000 and all, the tax slabs were adding with 10%, but now it is 5%. So that also has been a difference. But beyond that, actually, the only difference is otherwise there is no difference in the entire tax thing actually. So just for the year, sir, as sir has rightly said.
So the question asked is if the amount invested in share is it taxable? The same thing I think regarding long term and short term.
Yeah, it is definitely taxable as per the existing law. Now that dividend has become taxable. So please remember that there is no change in the tax law. All that you have to understand is that if you are opting for the new scheme or new optionally better tax slab, then you have to give away the deductions, and the deductions are also given, very clearly. These are the deductions that you are not getting. Other than that, if you are coming across anything, everything remains same.
Madam, just sir, I don't know whether I read the question correctly or not. What are the question? Amount invested in shares or income from shares, or what is that actually? What was the question?
Amount invested in shares.
No, so they don't get a tax on investment. Rather, we get the benefit of deduction, which may not be available over here. That's it.
So if it is a tax-saving investment, even in the shares, there are certain investment in the shares, then you will probably not get that.
So taxation, they are asking about whether there is a tax on investment of shares. So,
Okay.
Yeah.
I think that.
There's no more questions. I think all have got much clarity in what they are going to follow, whether the old regime or the new regime. With your case study, sir, it had been a really very simple to understand what is to be opted for. So one more question has come up. Dividend from shares and mutual fund are taxable with the individual companies. AMCs provide Form 16A. Whether it will be taxable in the hands of individual, that is the basic question.
So from this year, yes, it will be taxable because the dividend distribution tax has gone, and therefore it will be taxable in the hands of the individuals only.
Correct.
From the current. Earlier it was not taxable. Earlier,
yeah, it was covered in my thing.
Yes.
Yeah, it is taxable from now.
Dividend
on shares and also on mutual fund units. So whatever dividend now we get will be taxable if the amount exceeds 5,000. Up to 5,000 is not taxable, and there will be TDS also of 10% otherwise, but in the current it will be 7.5% because it is got taxable.
No more questions, sir. So shall I proceed? Yeah. I'm sure all. Yes, sir.
In fact, the session was so exhaustive. In fact, I think SEEMA madam also must have got the message from Principal Raje madam. She specifically phoned me also, maybe just to back it. She has given thanks to Sagar sir and also Indian Accounting Association. Of course, we congratulate your college also. And even Nishikant sir will not be now available because he has gone to the college. So this is the message from my side.
Okay, sir. Thank you. Thank you, everybody. I'm sure all the participants of the webinar would like to hear more and more from our speakers. But as we fall short of time, we come to the end of the webinar. The feedback link is in the chat box. Proposing the vote of thanks to Indian Accounting Association and Dr. Nishikant Jha, then to Seva Mandal Education Society, the management members who are always with the staff, guiding and ensuring their blessings. Special thanks to Bharatbhai Pathak for sharing his ideas. To our principal, Madam, Dr. Leena Raje, the force, the inspiration, and the motivation behind us to organize this webinar. To Vice Principal, Madam, Archana Patki, to my department, and to the key speakers of the day, CA Santosh Ghag, resource person, CA Sagar Jayawant, sir. Thank you all. E-certificates will be given to all the attendees today. The feedback link is in the chat box. The PPT will be shared in the Telegram group. Thanks and have a nice day.
Thank you.
Thank you.
God bless you. Thank you.
Thank you.